I am Victor Jones, and for the next hour, we're going to be talking about everything options, really everything derivatives here, from options, futures options, equity options, everything out there. We're going to have a good time over the next hour. As always, we want to encourage you guys to give us a call over the next hour. We'll take as many of them as we can. The number, as always, is 877-927-6648, and as we gear up for what should be, a very interesting cycle here. We've got about 3 more days here left in the April weeklies, in a high-powered earnings or tech earnings week here, and we're right smack dab in the middle of the May cycle. There's 24 days to expiration, so there's definitely lots of opportunity here to play. Whether it is weekly options, whether it's the May series, there's lots of opportunity. If you've never traded an option before, then you're in the right place. If you trade them all the time, then you're in the right place as well. Again, give us a call, 877-927-6648, as we always love to do at the top of the show, to give a quick market update on where we are today, and then we'll start talking about where we're going in the future. First, let's go ahead and take our first call from Tony in Rochester, New York, who has a quick question on Sears, ticker symbol SHLD. Tony, you're on the air.
Hi, thanks for taking the call, Victor.
Yeah.
I was looking to go long. I don't do options. Unfortunately, I didn't know that was your show today. But what do you think about it filling that gap back in February?
No, I think that's it's a great call, and actually it's for anyone else that's listening out there or similar to you, Tony, I think it's a good starting point for, I think, what our conversation is going to be around today, because we are going to talk a little bit about some earnings plays here, but this a little bit different, right? We've got Sears, which has been significantly depressed over the last option expiration cycle. When I say that, I'm talking from March 16th. Basically, the 15th is when it hit its peak over the last 2 months, and we've had a ride from 85 down to 51.24. So here's what I would say for those bulls that are out there. Obviously, we have implied volatility here, not obviously, but we have implied volatility here of 75%, Tony. And what that essentially means is that the market is pricing in over the next year an anticipation of inside a 75% move up or down. So essentially anywhere from, $40, $45 to the upside, or $40, $45 to the downside. And when you see something like that, it's kind of interesting, especially in a name like Sears. You start to think to yourself, well, a 75% move to the downside, I'm sorry, I think I said $40, something like 30, 35. You start to think to yourself about Sears, and you think, okay, a $35 move to the downside. Where does that actually put us? Well, it puts us kind of right around the $25 mark, right? $20 to $25, which is essentially its 52-week low, right around $29. So here's what I would say there, Tony, to answer your question very, very specifically. And anyone that's looking to potentially go long here in Sears, you have a stock that's currently trading at $51.22. Now, the opportunity here is to potentially sell a bull put spread, is what that's called, Tony. And what you would essentially be doing in May is selling the May 50 put and buying the May 45 put. And here's what that does. That essentially brings in about $1.90 in terms of your credit. So your obligation here when you're selling this put spread is what that is, Tony, and to all our listeners out there. If we're currently trading 51.22, you have the obligation to buy Sears if, in fact, it comes down and trades below 50. Now, if it doesn't trade below 50, basically expire, so in 24 days, if it's not below $50, you'll keep the $1.89. Essentially, that $190 for every one time you do this is yours. And if it does come down there below, your cost basis essentially in Sears is going to be $50 minus the $190. So essentially, if you have basically a $48 cost basis if, in fact, you end up earning Sears. So for those people that are looking at Sears here around that $50 level, and you're thinking to yourself, this could be an interesting opportunity, but the market really hasn't shown any strength just yet. I mean, if you look at it, we've probably had 13 straight down days from basically a doji in a bullish engulfing that really failed probably 13 to 14 trading sessions ago, and it's really just been, look out below since. So for people that are thinking to themselves, there could be an interesting entry opportunity, we've just filled that gap, as you mentioned, right around 51 to 52, 51 to 53. But you're not quite, clearly the market hasn't shown you strength yet. You can utilize options in a way that says, hey, I want to kind of nibble here. I want to take the opportunity. If we do rally, I want to make a little bit of money. But if we do continue to sell off, I want to minimize my cost basis risk. And in doing this, Tony, you actually kind of lock in what would be a cost basis of about $48 if, in fact, you get assigned the stock, and you're never taking on more risk than about $3.10. So basically, you have the opportunity to make $1.90, which is $190, and you never risk more than $310. So to put this trade on, to Tony and all the listeners, one time it would not cost you more than $310 in terms of buying power. So when I look at Sears, I see something that I would agree with you. It has been very depressed, and from a contrarian mindset, you start to think, $28 being the 52-week low, we've retraced 58% of that up move. We've also filled that gap. Could look like an interesting entry opportunity, but we can use options to get ourselves an optimal cost basis if, in fact, we continue to sell off. Because, again, the market hasn't shown us strength here in Sears.
Okay. Thank you very much, Victor.
Tony, thanks for the question. It was a great one. And as always, we appreciate all the calls today. And again, whether or not you've traded options before, whether or not you're looking to potentially trade your first one, or you're in a position you want to talk about management, feel free to give us a call, as Tony did, 877-927-6648. Let's do a quick market wrap-up. The S&P 500 currently trading 1369 3/4. We're up $7 on the day. Why this is so interesting? We've kind of been waffling right around this 1370 level. Well, I shouldn't say it. We had a significant correction yesterday with about 15 point down move in the S&P 500. So we've had a significant move yesterday, but really, if you look, what we essentially did is we came back down to around this 1370, 1360 area, which the market has tried to, in two significant moves to the upside, tried to get out of, but in both times, I mean, the first time it immediately gave up that move the very next day, and basically the last time we made that move up to around 1389, the market gave it up basically over 4 trading sessions, with yesterday kind of being that stamp. And now look where we are again, 1370, just kind of hanging here at this level. The market up a little bit, about $7 on the day. You have the NASDAQ, which, if we look at percentage terms, you have the S&P 500, which is up 0.5%, and when you look at the NASDAQ here today, we're down 8 3/4, which is 1/3%. So definitely a deviation between what you see happening in the overall market, what I'll call the overall market, in terms of the S&P 500, and what's happening in the NASDAQ. And clearly, that's because of some of the performance of the tech stocks. I mean, if you were to just look at what's happening in Apple today, down about $9. That's a significant portion of the S&P, of the NASDAQ, and we're going to get into Apple earnings. So all of you who are questioning whether or not to make that play, you've got a couple more hours to do so, and we're going to talk about Apple, what those expectations are, and then even on the fundamental side, what those expectations and those numbers could be, and what that in turn means to Apple, and what that also means to the NASDAQ in general. The market is pricing in about a 7% move in Apple in terms of earnings. So the market expects inside of a 7% move, one way or the other, either up or down, around $33. And that could potentially mean 20% there. It makes up 20% of the NASDAQ. So we're going to definitely look at what that means to the overall market here. The VIX 1838 down about 60 cents on the day. That's about 3% down on the day. So a significant jump in the VIX yesterday, and now we're a little bit lower even than where we started. Yesterday we're getting back to close to the levels right around 18 where we were 2 trading sessions ago. So we're trading inside of a range basically in the VIX, which is the volatility index. It tracks volatility of the S&P 500. So we're in a range between 18 and 20 essentially over the last 9 sessions or so. We also have the Dow, obviously, 12,968, up $97, a significant rally since yesterday, up about 0.75%. So relatively speaking, the Dow is the strongest indice of the 3, and that is of the S&P 500, the Nasdaq, and the Dow. The Dow up 0.75%, 96 bucks, still obviously not above the 13,000 level. We're hanging right around 33 points below. And the Russell 796.20, small caps very strong today, up $7.40. That's almost a full percent up on the day. As we move into what's happening with the dollar /DX, that is the futures contract that tracks the dollar against a basket of world securities, $79.27, up 1/3% on the day, down 1/3% on the day. 79.27 down 26 cents, down 1/3% against a basket of world securities. The euro stronger on the dollar, basically $1.3201, up spot 0.004. That's 1/3% as well. Gold stronger on the day /GC. That's the gold futures contract, 1641.50, up $8.90 on the day. That's 0.5% up on the day. So interestingly enough, you are seeing a little bit of strength in the S&P 500, a little bit of weakness in the Nasdaq, strength in small caps, and strength in the overall Dow, those staple components. At the same time, you're seeing strength in gold and strength in crude. What's interesting there is you saw the exact opposite yesterday. You saw gold come off a little bit, and you saw crude come off a little bit to the 1 and 2 level. Today, 103.58 in crude, up 47 cents. That's 0.5%. So as we get through basically our market wrap there on the day, you know, we always like to call out those divergences, and today is definitely a day where you see a little bit of difference between what's happening in the Nasdaq and what's happening with the S&P 500. Typically, we jump right into the S&P 500 for a little bit of analysis, but I think at this point in time, the action, so to speak, is really in the Nasdaq. So let's jump in, and we're going to look at the Nasdaq 100 futures contract, where we are now at 2639.75, down 10.25 on the day, and really the story here is Apple. So as we pull up Apple to really see what's happening here, Apple is down $11.51 on the day. That's now 2%. It was down 2% in pre-market, rallied to about down $8 to $9, and now we've given up those last $2 here over the last couple 10 to 15 minutes or so. Now, one thing to quickly point out, because we are talking about the Nasdaq, and whether you think about the Nasdaq in terms of the futures contract, which I brought up initially, which was /NQ, or whether you think about the Nasdaq in terms of an ETF, such as the PowerShares Triple Qs, that's ticker symbol QQQ, currently trading 64.83. The Q's put-call ratio, interestingly enough, is reached, I should say, the most bearish level in about 6 years. So essentially, it was trading 6.4 to be exact, to 1. So for every 1 call being traded, there was about 6.5 puts being traded in the Q's. And again, you have potentially a little bit of hedging happening there as we approach Apple earnings. But it's an interesting statistic, and I would encourage everyone to keep their eyes on the put-call ratio. As I utilize the ThinkorSwim software, that would be under Market Watch and then Watch, and then you could put in anything you'd like here. In this case, I'm going to put in the Nasdaq 100, and you can see the put-call ratio in the upper right-hand corner. So talking just a little bit more about Apple and what we should expect as traders, especially as option traders or as stock investors. It really doesn't matter. The street is essentially looking for Apple to move, or had moved, 31 to 32 million units over the last quarter. To put that in perspective, the last quarter, the expectation was about 30 million units. Apple came in at 37 million units. When I say units, I'm talking, of course, about iPhones. The expectation last week was right around 33 million, has now declined, and the reason it's declined, I think this is very important. If you've been watching, earlier this morning, you had AT&T come out with earnings, and then last week you had Verizon come out with earnings. We mentioned on the show last week that Verizon would be something to keep your eyes on in terms of an Apple trade. Why is that? Because they give a good base. Not only does Verizon, but also AT&T. If you look at the number of iPhone activations, or the strongest number of activations, those are coming from those two carriers. And what that essentially told us is that, the number, or the expectation, the number of units might not be as strong as the initial estimations, right around 33 million. So those have declined to 31 to 32 million. So when you're listening or you're watching those news articles, you're listening to whatever you'll be listening to, after close today in terms of Apple earnings, that number is the one that's really important. And why is that important? Because iPhones essentially make up a little over 50% of Apple revenue. So for something that makes up 50% of the revenue, you definitely want to know what those units are doing. If the expectation, as last quarter was, of 30 million units, and they moved 36 to 37 million units, you see a jump from 420 to 440, which was the move last quarter. So, But interestingly enough, you don't have that same setup here in Apple. In Apple, you have something that was basically down 12% over the last 2 weeks, but you have, since the last expiration cycle, something that's, let's call it the last two expiration cycles, something that's moved from 500 to 650 back to 550. But that's still a 10% move in essentially two expiration cycles. Take it back to another one since their last earnings. That's 450 to 550. That's 25%. A little under, really, 25%, in less than 3 months. You have a significant or a parabolic move that shaped up, and you have what's rightfully a little bit of profit taking here in the last 2 weeks. Again, Apple down around 12% over the last 2 weeks. And so if we jump into their options here, which I think is what you may all be listening or watching for, right? We're looking at Apple, and we're looking at the expectations here. And if you've noticed on the ThinkorSwim software in the upper right-hand corner, you have something called the market maker move, which is indicating to us that based on implied volatility, front month versus back month, we can derive a $33.15 expected move in Apple. Okay, so what that's telling us is essentially we're currently trading $555. And the expected move, or within 62% of the time, we would expect on this next earnings release to stay inside of a $33 move, which is around 6 to 7% of Apple's current price. So, where we're currently trading, if we look at how that essentially sets up, and if you have questions on Apple or you have questions on how to play it, give us a call here at 877-927-6648. What we're currently trading at, let's just call it $560. So on the upside, at $560, where does a $33 move to the upside bring us? We're just shy of $600, which was, a big round number, right? As it brings us to $593, approaching $600, which makes a lot of sense. If we were to break to the upside here, clearly a round number is going to play a little bit of a psychological resistance, if not a technical one. And then to the downside, if we're at $560, we've got a $33 move to the downside that essentially brings us to $527. So $527 on the downside would be, again, from an options perspective, around $527 is our downside support level, and $593 is our upside resistance. So where does that put us in terms of actually strategy? We're placing as high probability of a trade that we can put on here. And if we look at essentially what this allows us to do, if we're looking at the Apple weeklies here to the downside, if we look at that 525 to 520, that's essentially $1. So selling that vertical spread, the 525 to 520, again, explaining what I'm doing, this is a bullish put spread. Okay, selling the April and this is the weeklies we're talking about right now, selling the April 525 put and buying the 520 put. You do that, and you will receive a credit of approximately $1.10 today. For easy numbers, we're going to just use $1 because that's really the natural price of that spread. So if it's a $5 wide spread, and what I mean by that is we're selling the 525, we're buying the 520. The difference between those two strikes is $5. The difference between those two strikes is $5, and we receive a $1 credit. There's $4 of risk there. So essentially, we're risking 4 to make 1. And when you look at what that essentially means, that's about an 80% probability of success is where that essentially positions us. Now, keep in mind, this is a very short-term trade. Essentially, after tomorrow, when the implied volatility comes out of these options, if Apple stays the same, or if Apple has rallied, you'll essentially see a majority of the premium on the 525 to 520 spread come out. It's a very conservative bullish play here because you're getting essentially as far as you can get away from the current price in Apple. You're taking advantage of the implied volatility in the front month. And you're also staying as close to something that matches up with terms of risk to reward. Risking 4 to make 1 in terms of options is something at an 80% probability. It's probably the higher end of what we like to do. But still, typically we probably stay within 70-30 type range, so 70% probability of profit. But still, this is something that's available to you on the conservative end. And looking at where that support would be from where the options are priced, we have to know it's 527 today. On the opposite side, because, if you think about it from a fundamental perspective, really the opportunity here for Apple is really just a surprise with incredible units in terms of numbers. A similar surprise to last quarter, and the opportunity is definitely there because you've had, if you remember, the number last quarter was so significant. And the reason it was so significant is because essentially you had Apple releasing the iPhone 4S. So you had a lot of demand there. Essentially, they moved around AT&T has reported that they had about 4.3 million iPhone activations this quarter, and AT&T reported this morning, versus 7.6 million in the fourth quarter, basically the previous quarter. So essentially, we know already that there have been less AT&T activations by a significant number, probably about 60% or so. So 4.3 million in the previous quarter, in today's quarter, in AT&T iPhone activations versus 7.6 million in the fourth quarter last quarter. So, but what you have on the opposite end is essentially the iPhone device, which was released internationally in this current quarter. So while the U.S. was very, very strong last quarter for Apple and for AT&T, you have now an international growth or international strength, which is expected a little bit from the January to March quarter. So it's going to be very interesting when we get these results to see what's actually happening there, as they did release the new iPhone technology internationally in China as well as other countries, basically mid-January. So if those numbers come in and they're significantly strong, you're going to see an upside move. Otherwise, you have essentially no expected new product news that will come out and potentially help the momentum. So really a bullish play here is a play on units. So on the opposite end, if you're looking for something that you're thinking to yourself, hey, we've had a significant amount of momentum here. We're up almost 20%, 25% over the last 3 months. Even though we're off 12% over the last, let's call it 2 weeks, there's the opportunity here, if units are even on par with expectations, to give up or take a little bit more profits. If we start looking at the similar logic that we just used, the 590 to 595 on the upside, or essentially really the 595 to the 600 bearish call spread. So if we look at that, we're making about $1.12. Again, what did we say was our resistance to the upside? It was 593. So on the upside, 595 would be potentially where you could position a short call and still be above that number, and you're bringing in about $1.10. Again, this is a case where you're risking 4 to make 1. You're getting as far outside or as far conservative as possible and keeping your numbers at 80% probability of profit here. But again, I think if there's ever been an Apple earnings where there's the possibility here to have a significant move, I think this is the one, and you're just seeing some of the profit taking, the last 12% over the last 2 weeks, and that could get interesting. If we come in at 31 to 32, coming under, it could get a little ugly. And I think, if we're looking at upside resistance, you're thinking to yourself, hey, I want to take a bearish play here and a little bit of profit taking on these earnings, which again has been risky to do in Apple historically, but the opportunity here is a 595 and 600 call spread. And you might be thinking to yourself, why are we looking at the weeklies? And the reason we're essentially looking at the weeklies is for a simple reason. If you feel the risk is basically, you're going to take a bullish play, maybe something similar to the first trade we looked at. The risk there is that we're at 80% implied volatility, and after essentially the news comes out, if we do have a significant move to, let's say, below even where you think where the options are pricing this downside move, you'll have implied volatility be propped up just a little bit. Even though you're going to see a significant drop from 80% to somewhere around 50%, you're still going to have volatility propped up just a little bit because you've had a significant move, and the options are going to be priced as such. So you might have a little bit of value there left in the weekly options to roll them to the monthlies. And then to the upside here, again, if you see a significant move to the upside or significant beat, if you feel that there's going to be a little bit of upside resistance around that 600, the options may hang on to a little bit of their value enough to roll to the monthlies, and if not, essentially they're going to lose all of their value. If you make the right call here, they lose all their value. They're going to lose it very quickly, essentially day over day, versus the monthlies, which may hold a little bit of value. So if it's an earnings play, the weeklies are available for you to make it a straight earnings play. And that's essentially why we're talking about the weeklies here today. So a lot of talk there on Apple in the first half hour on our show, but we've got a lot more to talk about here in the second half hour. We appreciate anyone who wants to give us a call, whether it's on Apple, overall market, as Tony called about Sears earlier, anything you want to talk about here, feel free to give us a call, 877-927-6648. Again, 877-927-6648. Now, as we talk about techs here today, and I think it's interesting to talk about techs. Last week was really financials. This week is really techs, tech heavy, I should say. IBM came in with decently, positive earnings here. At least raising their dividend about 13 to 14%. So, they sold off, as most of the techs did over the last couple of weeks, along with Apple, from 210 to 201, basically 200, a little bit less, 190, have now rallied. They're up $2.68, up about 1.33% to 201.31 today. Again, we're going to raise their dividend about 13 to 14%, so a little bit stronger. We're going to read the number one more time for you guys to call in. It's 877-927-6648. So again, IBM, another tech that came in with positive earnings just yesterday. We talked a little bit about AT&T being down about 43% quarter over quarter in terms of iPhone activations. As I bring it up on the chart here, we'll just quickly look at it. We're going to look at trades on all these here. But you can see earnings were significantly above expectations, came in about 60 cents here today. So even though only 4.3 million activations in the quarter, it was above expectations as well. One of the interesting ones that just came in yesterday was Netflix, NFLX. And as we talk about Netflix here, and this is kind of the Cinderella story turned ugly stepsister, turned Cinderella, turned stepsister again. And earnings is always kind of for lack of a better term, a fun time to start looking at Netflix, because you start to see a little bit of volatility there. You start to see an interesting move. As you know, Netflix rallied from about $60 up to $120. Has had some interesting range-bound movements between 105 to 120. Was at the lower end of their range at 100 into earnings, and gap down to $88.01. Basically, they fell 14% on better than expected earnings, but low streaming customer forward guidance. And if you've been following basically their customer makeup, streaming makes up more than 50% of their business. So they're coming in with guidance that's lower than analyst expectations, or a customer estimate that's lower than analyst estimations. So that's being priced into the stock and repriced into the stock versus what those estimates were at 105. So you're seeing now a Netflix which is basically $20 cheaper than it was a couple of days ago, down 13.81, basically at 13 2/3%. And even still, when you see a downward move, this went from 85% implied volatility down to about 60% implied volatility. Still relatively expensive in terms of volatility, in terms of premium in those options. And so as we look at Netflix and we start to look at those options before we, at the end of the show, come back to IBM, we're looking at Netflix here, and we're seeing the at the money straddle. Okay, the at the money straddle. And what is a straddle? A straddle is a at the money. So if Netflix is trading at 87.82, we would look at, basically we would start to look at the $90 strike price, because $90, there's an $85 strike price and a $95 strike price available in April for Netflix. 87.80 is closer to $90. So we're going to use the $90 strike. The call is worth about $1.30. The put worth $3.50. Together, that's about $4.80. The at-the-money straddle is worth $4.80, even though the April or the weekly options have only 3 days to expiration. So what does that mean? Let's look at that. $4.80, we just round that up to, let's leave it, $4.80. That's about a 5% move in the underlying. In just under 3 days is what the market is pricing this into. The reason I bring that up is because it starts to get interesting, especially for premium sellers that are looking for increased volatility and a way to potentially sell a little bit away from the current market to make a little bit of money. Here's what I mean by that. On the upside, if you feel Netflix will continue, or on the downside rather, if you feel Netflix, at least over the next 3 days, may continue its downside move, you have essentially the 92.5 call spread, which is priced out at about 60 cents. So you have $2.50 of risk. Basically, you're risking $1.90 to make 60. It's about 3-to-1 payout. So if the idea is that from now until expiration, and even on a day where the market's recovering from yesterday's move, up $5, you're seeing Netflix a little bit weak in the face of that. This is, again, a little bit more of a speculative play, but this is just an idea of how sometimes you can utilize weekly options to make very short-term and very speculative plays. The idea here is that Netflix will continue to trade below 90 from now until this Friday's expiration of these weeklies. You could basically take in 60 cents for a $1.90 bet that we would stay below that strike price. The probabilities of that occurring, I think, are very important, as we've talked about many times on this show. So if I look at the probability of expiring out of the money, okay, the probability of this occurring is about 67%. The probability of us expiring, or Netflix expiring below $90 from now until expiration is 67%. Again, probability is always changing, and as new numbers, new information comes into the marketplace, as time erodes, those probability numbers are always going to change. So it's important we understand that going in. But if we're looking today, from a probabilistic standpoint, at kind of what plays are there, I think on the downside, this is an interesting play. because of the high volatility available in the front month. On the opposite end, if you're someone who thinks, hey, tomorrow I think maybe the market overshot itself to the downside and there may be a little bit room here to rally, you've essentially got a very interesting play on the opposite end. And a little bit more, actually about a similar play. The problem here, though, is that you basically have a 5 wide. Instead of 2.5 to the upside. What I mean by that is you have a 90 to 92.5. That's $2.50 wide that we're talking about in Netflix calls. On the put side, for a bullish play, you've got the 85.80s. So you have a $5 wide, and because you only have 3 days, it's going to be a little bit less of a risk-reward payout than you might expect. It's 85 cents for the credit, which basically means you're putting on $4.20, $4.15 really of risk to make 85. So you're starting to creep into that, 85% probability of success, and usually 80 is our ceiling, but really just depends on what your feel is on Netflix. But just talking about how we can use options, to execute a strategy, I think that's a great place to start. As we'll remind everyone, we've got about 18 minutes remaining in the show. Feel free to give us a call, 877-927-6648. We'll answer as many of those questions as we can. Now, we've talked about, obviously, Apple, the big fish on deck here today. We've talked about IBM, which is also reported. We talked about AT&T, which reported this morning. We've just quickly talked about Netflix. There's another one on deck, or basically that has reported. That's Texas Instruments. And I think this one is an important one to note just because of the chip side. We'll talk about TXN really, really quickly before we get to a few other really big names here. But we have TXN, which is, if you've been watching them, they just made a move from 32.75 down to about 31.25, about a $1.50 move. They're down 2% on the day today. They shed about, now 63 cents. Earlier this morning is about 11 cents, on a 60% drop on earnings since the previous quarter. So 60% drop in earnings, essentially. Not a very compelling quarter. And you're seeing something that was, interestingly enough, very range-bound, as we had talked about. We had talked about this basically last week. We saw a range between 32 and 34 shaping up. And essentially you saw earnings come in as we were trading right in between that range. Very, very disappointing earnings in terms of Texas Instruments, which brought us below the 32 strike. So what I want to talk about really, really quickly is if we are short at 32, what is the expectation here? And if we're short at the 32 put side, I want to just show quickly, and again, these probability numbers, the probability of expiring out of the money. At 32, basically in the Aprils, it's only 27%, but clearly we had talked about putting on a May position. We look at those 32s, there's about a 33% of expiring out of the money. So essentially there's a 66% chance that Texas Instruments from now until May expiration does not rally the 75 cents needed to bring us above 32. Now, clearly, that's just based on what we're doing today. And a day like today, right after earnings, where the market quickly gives up 2%, it's remained to be seen what will happen tomorrow. We get a little bit of recovery. And I think it's, interestingly enough, because we're on the tech side here, if Apple does not come out with positive units, basically positive iPhone numbers here tomorrow, after the close, we could continue to see a little bit of weakness in the NASDAQ, and I think that it'll reflect on all individual securities. So really making a short-term bounce here play in Texas Instruments, I think you have to be aware of what that overall market is doing and what the overall broad-based indice is tied to, which is Apple. I think you just have to be aware of those correlations. And in order to take anything positive here, or a positive move, I think it would be prudent to kind of see what shapes up here with Apple and what the NASDAQ does. We do want to also talk about Baidu here. And I think it's important to talk about Baidu because, we have earnings coming up. And so when we look at Baidu here, the market maker move, or the options are telling us to expect about an $8 move in one direction or another. You've seen about the same action here happen in Baidu that we've seen in the NASDAQ over the last couple of weeks as Apple has turned around. You've seen us back off the 152.30 level down to 136.66. So we've made a move from 152.30 down to 136.66 in just the last 8 trading sessions. So a significant downwards move, and in that same time you've seen implied volatility raise to about the 46% level. So the expectation here is about 84.5 cents in terms of earnings per share. It's been depressed before. I mean, if we just look at what a simple technical resistance, basically you've seen Baidu reach for its bottom side support here at about the 135 level. So let's take a look at the options and let's see what's happening here. So if we look at if we're looking at the May options, actually we can look at the April, the weeklies, just to get a better indication of what's what to expect. $8.14 is the expected move that we're basing the Baidu options or Baidu earnings movement on. And for those of you out there, we talked about this just a little bit last week. I want to give the calculation again. For those of you who are out there and you want to say, hey, what if I'm out and about and I've got my smartphone on me, I've got an option chain in front of me, and something has earnings. I want to calculate what that expected move is due to earnings. How do I do that? Well, Baidu right now is trading 136.62, so the closest strike price is 135. There's a 135 and a 140. It's closest to 135. We would take, again, we learned about that at-the-money straddle earlier today. We want to take the price of that at-the-money straddle. The call is trading about $5.50. The put's trading about $3.80. The at-the-money straddle, $8.80 approximately. So if we remember in the back of our minds that $8.80, how did we then calculate, what do we do from there? Well, we would take the first out-of-the-money strangle and add it to the straddle price. What is a strangle? It's the first out-of-the-money call. Okay? So the first out-of-the-money call. So if we're currently at 135 as our at-the-money, the 140 would be our first out-of-the-money call. And that's trading, let's call it $3.10. Now let's take our first out-of-the-money put. Okay, first out-of-the-money put, if the at-the-money is 135, is 130. So the 130 put is trading $1.90, let's call it. So let's add 190 to 310, we get $5. Okay? So $5, if we add that to our 880, we're going to get $13.80. Okay, if we divide that by 2, we get somewhere just under $7. So it's significantly or a little bit below the $8.11 where we are. But if you needed some thumbnail way to get this sort of calculation, that is the way that you can do that. You just take your at-the-money straddle, remember that term, and you add your out-of-the-money strangle. Funny terms here, right? And once you get that, you divide it by 2. And so that would give you some sort of thumbnail estimation. And I want to provide that because, obviously, if you're using the ThinkorSwim software, you get this right offhand, $8.12 available in the upper right-hand corner. But for those people that want to, calculate it manually or give themselves a thumbnail, whether they're on the road using different software, whatever it is, that's how you do it. We've got a quick call from William in Singapore. He's got a question on an Apple Iron Condor. William, you're on the air.
Yes, hi, Victor. Thank you for taking my call. I think I like the ideas for what you mentioned just now about selling the call spread, and the put spread, to take advantage of the earnings. So if the if the swing of the price is within that probably about $40, we probably capture that premium for that weekly options, right?
So I think, say that one more time, William.
Okay.
So you said you like the ideas that we went through. We talked about the selling the bear call spread and bull put spread. We talked about both of those depending on if you're bullish or bearish.
Right.
So walk me through exactly what the question is from there, William.
Okay, I like that idea, so that if the swing of the price is within, 520 and 600, we basically capture that premiums.
That's a great question. So let me go with that just a little bit, William. So we've got about 8 minutes or so in the show, and I think it's a good topic here to talk about, unless we get a couple of quick calls. But in terms of Apple. So what we talked about here in the weeklies is because that front month basically has 80% implied volatility versus a back month of 45%. Essentially, there's 35% volatility differential in the front month. So it's propping the values or the richness of those options up a little bit. And because the anticipation in terms of price into those options is about $33 one way or the other, we calculated our support and resistance based on options instead of a technical support and resistance. We find though that those often correlate to some technical support or technical resistance. In our case, we found 525 on the downside, 600 on the upside, 600 corresponding to a round number, which plays a little bit of a psychological resistance number, and 525 on the downside we've seen a couple of times on our quick parabolic move to the upside. We played around 525 or broke down to 525, and it played a little bit of support before. So those numbers, while that we pull them out of an option on the option side, they also kind of play into a technical side as well. Now, what we really talked about was two different and opposing trades. If you're bullish, this is an interesting opportunity, or this is a way that you can potentially use the expectation in terms of magnitude of move in your favor, whether that's to the upside or the downside, to try to give you a decent risk to reward and stay as conservative as possible, if there is such a thing as a conservative earnings play. So what William is talking about, he's thinking to himself, he's saying, hey, you talked about potentially selling the 525, 520 put. You also talked about selling the 595, 600 call spread. What happens if I package those together? Because I'm going to bring in at that point $2 for a $5 wide spread. So now my risk here is only $3 because I bring in 2 to sell each one of those. The market can't be in two places at once. So if I sell the put spread and the call spread, I'm going to take in, I'll basically take in $2. I'm still 5 wide, so my risk is still only 5. So I reduce my risk from $4 if I just do one to $3 if I do both of them. But obviously the risk here is that William doesn't have a directional play if he does this. This is a neutral play. He's saying that the market expects on this particular move or this particular earnings play and move inside of $33. So as long as the market is correct in terms of the option price today, tomorrow, if we're within that range, I should have a profitable position. And I think it's an interesting one, William. I would also say that I can't remember too many Apple earnings of recollection where you didn't get a move in one direction or the other. Now, whether that's outside of $33, I think the risk probably here is that we don't have a $33 or above a $33 rally to the upside. It's going to be tough for Apple to just completely knock it out of the park with, let's say, 40 million phones versus 31 to 32 million estimation. I think the risk probably of exceeding that move is to the downside, given the significant run to the upside. So I think, William, if in fact you do something like this, just be aware that the risk probably there is to the downside and that you will see some movement, so be prepared to take a little bit of heat if in fact you don't have, as you don't, I think, William, going in here, I don't think you have a clear conviction in terms of direction here in Apple, which is why you're thinking about putting it on an iron condor. And I think in doing so, you could put on, the weeklies give you an opportunity that if you do miss to one side, you're going to be profitable on the other. You can close out almost, probably as close to no bid as you could. And then you have the opportunity to roll to the next month. So if you're thinking to yourself, hey, the risk here is that we missed by, let's say, $40 to the downside, and you would feel comfortable rolling that put spread into May and giving yourself a little bit of time for Apple to recover, if in fact you do think this is a good price for Apple, then I think there would be your opportunity, just knowing that you're going to lose on the April put spread to roll into May. So I think it's a fantastic question, William, and I think those are probably your risks in doing something like that. So I'll ask, going into Apple earnings, do you have a clear conviction one way or the other?
I was thinking if in the event if you're going to move, parabolic on the up and the downside, another way is, to add on to this position, I put on another, May, what you call call spread, bull call spread and, a bull put spread. That means I'll buy a May, say for instance, 606.05, to protect my, just in case it went way above, then I buy that, May positions, say for instance, 595, 600 or 605 position, bull call spread, as well as the other way is, the bad bull spread. I'm not sure whether that makes sense.
Yeah, I think, and interestingly enough, if I remember correctly, a couple months ago you did the same thing and ended up with a significant rally to the upside. I do think, William, you have to be careful here in looking for another $100 rally in Apple. So I would just be careful about the level that we're at, and I would start to maybe, look at even on the upside a little bit more conservative play. So I appreciate the call, William. We'll do a quick market wrap up before we go ahead and end the show. Thanks as always, William.
Thank you.
Yep, S&P 500, 1366.25, up $3.50. The S&P gave up about $3 since the beginning of our show. 1841 is the VIX, down 56%. That is also came in just a little bit as well, interestingly enough. The NASDAQ, 2630 and 3/4, down 1950. Accelerated selling in the NASDAQ, now down almost 0.75%. The Dow, 12,948. Up $77, lost about $20, up 0.2%. So we'll be looking at all the tech earnings, everyone, for the rest of the week. I wish you a great week of trading. We'll see you next week, same place, same time here on the Options Hour.